There's a big divergence in the market and it's getting worse. We're going to talk a little bit about that. I'm going to show you some economic data that suggests to me that a recession is not in the near term. So first up, let's take a look at why we have this big divergence in the market. We need to remind you that the S&P 500 is cap weighted. If you take a look at the chart on the screen, that is the top 10 stocks in the S&P 500. And when you do that math, that equates to about 39.9 or about 40% of the S&P 500. So whatever the S&P 500 is doing, it is very heavily influenced by 10 of the 500. I think there's technically 503 stocks in the S&P 500. Only 10 stocks really are moving that index. What does that mean? Well, on the screen now, I've got two ETFs. The green line is SPY, one of the S&P 500 ETFs. It is also cap weighted. The blue line is RSP. RSP is an equal weight version of that. And I want you to see from July 25th until last Friday, RSP, the equal weight version of the S&P 500, just really moved sideways, even though the broad S&P 500 moved up. So many people say, hey, the market is moving up. No, it's just 10 stocks. Ultimately, what this is doing is it's creating a very big divergence. In the top pane now, I've got IWV. This is the Russell 3000. It makes up about 95% of the U.S. stock market. And this bottom pane down here is the advanced decline line. What this is telling us is we've got more stocks that are declining than are rising. That is a problem, and it's not sustainable. We also can see, and this makes sense, if you look underneath the surface, there's approximately 52% of this IWV, approximately 52% of these stocks are above their 200-day moving average. Said differently, 48% of the U.S. stock market is in a downtrend. That is not healthy. Let's talk about filing the news. What do I mean when I say that? Well, for the most part, I mean ignore the news. At a minimum, ignore the headlines. You really need to learn to filter out a lot of what you hear or a lot of what you read, because we have to recognize that the media is in business for a reason. They're in business to make money, and they make money by getting advertisements and viewership and things of that nature. They're not in the business necessarily of giving you accurate news. We have to remember that. So when I look at the data, I don't see enough data that right now that suggests that a recession is in the cards. So just last week, we got some news that layoffs have spiked and that they are the highest they've been at in the last 20 years. Well, that may be true. I, for one, am going to wait until I see it in the actual data. This is the official data from the Federal Reserve Economic Database, as is all of the charts I'm about to show you. Now, this particular chart, the next two charts, were supposed to be updated last week, but I suspect they haven't been updated simply because of the government shutdown. So when they get updated, I will take a look at them, and I will probably post something to our blog or my LinkedIn page. You can check that out. But when I look at this, I don't see anything that suggests I should be concerned at a macroeconomic level. Because the reality is where we're at right now, that's the black. If you look at that black line is the bottom of the range for the last 20 years, and we're now just getting to it. Now, if we get to that green line, that's when I'm going to be a little bit more concerned. So again, the jury's still out on this one. I will update my thoughts once I get an update to the chart. Now, this is job openings. This is a concern, absolutely. You can see the massive drop from COVID and this massive rise after COVID. Once the Federal Reserve pushed all that liquidity into the economy, it caused a big spike. I would argue that's the primary reason we had all that inflation. But you can see that we've had this massive downtrend in job openings. This has been prevalent for quite some time. The red lines that I've drawn on the screen are just me trying to level out the data to say, well, it looks like maybe we're getting back into a range here. And if job openings falls below the bottom red line, I'm going to be concerned. But I also wouldn't be surprised if over the next several months, we start to get job openings rising above the top line. If we're staying in between the two, I'm not going to be too concerned. That said, there is a little bit of a divergence between these two data sets. The blue line is temporary help or temp workers. And the green line represents total non-farm payroll. And if you go back since the late 1990s, you can see a heavy dose of correlation between these two data sets. That has been diverging for a number of years. I'm not quite sure what that means, but it's definitely something to keep our mind or our eye on. Now, when I say that I don't see anything that suggests a recession in the near term, this is one of the reasons I say that. This is the household obligation ratio. What this looks at is the total debts, if you will, for the average American. And you can see, has it risen? Well, yes, but this was a historic low after COVID. And if you go back to the 1980s, we are well below where we've been for quite some time. So this indicates that the average American household has a relatively good debt to income ratio. And when you look at credit card delinquency rates, again, you see this is a very low number. Has it risen from the COVID lows? Yes, it has. We would expect that to have happened. But look where we're at as it relates to history. So when I look at the data, I see that the average American household is in pretty good financial shape. And I have a hard time envisioning a recession occurring when everybody seems to be prepared for a recession. I started today's video by showing you the divergence that is happening between the traditional cap-weighted S&P 500 and the equal-weighted RSP. Well, my friend David Lundgren over at Motor Capital Management has an even better chart that shows just how bad this divergence really is. In the top pane, we've got that traditional cap-weighted S&P 500. In the bottom pane now, we are showing the value line geometric average. The difference is the value line geometric average is a broader measure than RSP, and it is also equal weighted. And so he's done a good job of highlighting this, just how bad this divergence is. We're going to come back to that in just a second. But first, we want to talk about the Federal Reserve. This is the inflation, and you know the inflation battle that the Federal Reserve has been waging. We had this massive COVID-induced spending spike, which led to the inflation that has largely been brought under control. Well, the Federal Reserve has been saying for quite some time that they want to get to 2%. That's their target. Well, I won't bore you with the history, but it is largely an arbitrary figure. Well, the reality is that we are now below this 10-year average, and now the Federal Reserve is starting to ease. They have lowered interest rates a couple of times, and there's some suggestions that they might be doing it again. Well, normally, if you've got struggling companies and struggling economy, that's when the Fed is going to ease. They have not been easing because they're worried about inflation. Well, if inflation is not really a big concern and they put that battle down and they start easing, well, there's an argument that perhaps this divergence is going to be resolved. I guess divergence, it can't go on forever. So it's either going to resolve down, and if that happens, I like our process and I like our ability to shift into defense quickly. If it resolves to the top side, which is what I would suspect is more likely to happen when I survey the landscape, I think that is actually more likely to happen. I like our process and our chances in that environment as well. Thanks for watching. If you haven't gotten a copy of my book, I hope you will do so. If you have any questions, by all means, feel free to send me a message. Thanks for watching.